Hello and welcome to Energy Insights, your source for the latest energy analysis. Today we are covering the latest developments in the energy market. So, starting from the Chinese refiners, which are paying the premium for the Iranian crude, similarly, the AI related power consumption, and also the market overview. So, we will cover all these analysis uh, context in three different segments. So, starting from our segment one, which is related to the Chinese refiners, which pay premium for the Iranian crude. So, in today's opening segment, global oil markets are responding to an unusual but important shift in the crude trade flows, as Chinese refiners are now reportedly paying a premium for the Iranian crude oil, marking a clear break from the long standing pattern of discounted sanctions barrel. Recent reports indicate that select Chinese independent refiners have purchased Iranian light crude at a premium of around $1.50 to $2 per barrel over Brent, reflecting tighter availability of the alternative medium sour crude grades and stronger near term demand in Asia. What makes this development significant is not just a transaction itself, but what is signal about the broader market structure. For years, Iran crude has typically traded at a discount due to sanction risk, limited buyers' access, and logistical constraints. However, the current pricing behavior suggests a temporary inversion in sanctions economics, where supply security and delivery certainty are now being valued more than the headline discounting. So, from market perspective, this shift is being driven by three key factors. First, tightening regional supply of medium sour grade uh, is increasing competition among the Asian refiners, particularly in China, where independent refiners have flexible procurement strategies. Second, the global shipping and geopolitical risk premiums, especially in the Middle Eastern supply routes, are pushing buyers to secure barrel earlier and with greater certainty. Third, intermittent adjustments in enforcement intensity around sanction flows are creating short term pricing distortions that allow certain cargoes to clear at stronger values. So, the broader implication is that the global crude market is becoming increasingly fragmented and non linear in pricing behavior. Instead of a uniform discount for sanctioned barrels, we are now seeing selective premiums emerge where delivery reliability and logistics certainty overweigh geopolitical risk adjustment. In essence, this development reflects a deeper structure shift. Crude pricing is no longer purely a function of quality and location, but increasingly a function of access, risk tolerance, and trade route security, with Chinese refiners once again acting as a key price sensitive but opportunistic force in the global oil market. So from segment one, let's move on to segment two, which the data centers power demand and the household cost pressures in the context of Australia. So now we shift from the supply side shocks to growing structure challenges on the demand side, the rapid rise of data centers and their impact on the power system. So this we will cover in our segment two. So across advanced economies, particularly in Australia, utilities are raising serious concerns about the scale of electricity demand coming from the data center. Driven by AI, cloud computing, and digital infrastructure, these facilities are no longer marginal consumers, they are becoming a major industrial scale loads. Grid operators are now receiving connection requests that rival entire regional demand levels. In some cases, a single data center is seeking as much power as a mid sized city. So, this creates a new kind of pressure on the system because, unlike traditional demand growth, this surge is highly concentrated, it's rapid, and it's infrastructure intensive. So, the data centers require not just electricity but also cooling systems, water resources, and grid stability support. This brings us to the core issue: who pays for the expansion? Utilities are warning that if the regulatory frameworks are not properly structured, the cost of new generation capacity, transmission expansion, and grid upgrades could ultimately be passed on to the household consumers. So there's a real risk that households end up subsidizing digital infrastructure growth. At the same time, system reliability is becoming a concern. Large continuous loads like data centers can stretch transmission networks. It can increase peak demand pressure and require additional balancing capacity. There's also a parallel constraint with the water. So data centers rely heavily on the water for the cooling, and only limited regions can sustainably support this level of demand without affecting local water security. So from segment two, we are now diving into our segment three, which is the market overview. In today's market overview, we are seeing a broader, firm but highly divergent global energy complex where the crude strength is primarily driven by geopolitical risk premiums, while physical and regional benchmarks continue to show signs of adjustment and normalization. So, in the case of the global crude benchmarks, WTI recorded price $98.65, which is an upward moment of point $80, almost 80 cent. So Brent upward with $1.04 with the recorded price $96.92. Similarly, the Murban crude recorded price in the market $99.62, which is an also upward moment of 2.03%. So, crude markets remain firm across major benchmarks, with Murban outperforming both the Brent and WTI. This reflects sustained Asian demand strength and tightening availability of the Middle Eastern crude grades, particularly in the sour crude segment. In case of the OPEC and Gulf benchmark crudes, OPEC basket price remained $107 with a downward moment of 13.79%. Similarly, Dubai crude also slipped down to $104.15 with a down moment of around 12.52%. So Brent weighted average remain $93.91 with also a downward moment of 14.33%. So despite strength in the future markets, OPEC hiked uh, and the Gulf physical benchmarks are under pressure. This indicates a lag in the physical market adjustment as early supply tightness is gradually normalizing while demand signals stabilize. In case of refined products, the gasoline price remained $3.19 per gallon. Similarly, the heating oil remained $3.98 per gallon. Both shows an upward moment. So refined products continue to outperform crude, particularly heating oil and the diesel-linked distillates. This reflects structural tight middle distillate balances and continue to signal strong industrial and freight-related demand. Uh, in case of natural gas and the LNG, the Henry Hub price remained $2.67, which is an upward moment 0.15%. Similarly, the Dutch TTF price remained $15.56, which showed a downside moment of 14.02%. Similarly, JKM, the Japan Korean marker, also recorded price $19.49, which shows a downside moment of 1.89%. So gas markets remain highly regional fragmented. US gas remains stable and structurally low. Europe is easing due to comfortable storage levels, while Asia LNG benchmarks are softening slightly and balanced seasonal demand. Uh, the overall market structure today is clear that crude oil firm and geopolitically supported. OPEC, Gulf, and the physical barrels are under adjustment pressure. Refined products stronger than crude, led by the diesel and heating oil in the gas markets, structurally fragmented with no unified global trend. Uh, and the energy companies' stock performances. So the equities are increasingly driven by the local currency exposure and the regional capital flows while still reflecting global crude price sentiment. In case of the New York Stock Exchange, the ExxonMobil recorded price remained 118 to 125 dollar. Similarly, the Chevron remain in the range 155 to 165 dollar. Occidental petroleum remains 62 to $68. So in case of Europe, the Shell price remained 65 to 70 euro. Similarly, the BP 35 to 40 euro, and the Total Energy 65 to 72 euro as a regarded stock price in the market. In case of the Asia and Middle East, the Saudi Aramco price remained 32 to 30 for Real. Uh, Similarly, the Petro China, Hong Kong dollar 6 to 7, ONGC 270 to 300 Indian rupees. Uh, so today's global market reflects three-layer structure. Physical crude markets are normalizing downward from the earlier tightness. Future markets remain firm due to geopolitical risk premium. Refined products continue to show relative strength versus crude. Gas markets remain regionally disconnected and structurally uneven. Equities remain stable, currency sensitive, and cash flow driven. We are currently in multi-layered energy market where crude is driven by the geopolitics, products are driven by real demand, and gases are driven by a regional balance. This divergence is what is keeping the global energy markets volatile, uneven, and highly reactive at the moment. So this concludes our today analysis. Thank you for watching Energy Insights. If you have liked this analysis and you feel it's helpful to you, so please like and subscribe the channel. Thank you again for watching Energy Insight.